We often overlook, okay, the way we accumulated the wealth is oftentimes not the best way to distribute the wealth to us. What are some of the best ways to distribute your wealth back to you? And again, this isn't a one-size-fits-all solution. It's different for everyone, but I'm just going to go over the concept here. So when it comes to distributing wealth, a very effective way to go about that is using an annuity with an insurance carrier. High-level overview, what's an annuity? You're essentially giving a lump sum of money to an insurance carrier, and they're giving you, in exchange, they're giving you a paycheck that will last for the rest of your life. In a nutshell, high-level overview. I have other I'm going to be making other videos really deep diving on annuities. High-level overview, that's essentially what an annuity is. You're trading an asset, whether that's funds from a 401k or wherever you have that cash built up. You're trading an asset for a guaranteed paycheck that you can never outlive. Okay? So that's really important, because when we're talking about traditional retirement advice, 4% rule, this is an alternative to getting more to the 4% rule. So again, I'll go over an example. Let's use the same $1 million I was talking about with the 401k. You got $1 million in a 401k and you want to withdraw, you're going to follow the 4% rule and take 4% of that a year. Well, with annuities, not all the time, but some annuities might give you a payout of, if you're older, the better with annuity, but you might have a payout of 6-7% I've seen lately. I have a lady I'm working with right now. She wants to retire at 67 years old. The payout factor is 7.5% for her, guaranteed, which is to me, that's crazy. If you had $1 million and you're going off the 4% rule with your 401k, that's $40,000 a year in income. Well, in this scenario with the annuity, $1 million in there, and you're guaranteed to get 7.5% payout factor. That's $75,000 a year, guaranteed. And something I want to add there too is with an annuity, how it works, when you deplete your original balance, you're still going to receive that check every single year for the rest of your life until you die. And whatever's going on with the markets, whatever's happening in the world, especially if you're with a really solid carrier that's been around for a long time, has a good track record, you're going to keep getting that check every single year. That $75,000 in this case, every single year. And that's where you start to open up the doors of a whole new world, because it's like, okay, I know for a fact I am going to get this money. And I know if my 401k or other assets go down, and I set it up in a way where my guaranteed income, supports my lifestyle, my minimum expenses, and just maybe some giving, however you want to go about that. But if it's set up in a way where your guaranteed income covers your lifestyle, let's call it that, that's just it's just such a great feeling, because you don't have to worry and question, am I going to, one, have enough money to last the rest of my retirement? And number two, is it going to be enough? Because you already diligently planned, hey, this check or this amount of money is going to be enough to cover my lifestyle. And obviously that looks different for everyone. There's inflation and other things to consider, and that's where actively managing a retirement plan is important. But the point is, an annuity could be, in a lot of scenarios, the most effective way to actually distribute your wealth back to you. And a question I hear all the time, or rather a statement, well, I guess the question is, that makes no sense. Why would I give $1 million, in this case, why would I give $1 million to an insurance carrier for them to give me my own money back? I hear that all the time. It's like, okay, then you manage your own money and distribute 7.5%, $75,000 a year on that money, at least every single year. Knock yourself out. It's because they're taking on all of the risk, and they're the ones that have to pay that to you no matter what's going on. If they, again, that's why the carrier is so important. But they're the ones that are managing that risk for you. It's if you want to be your own, manager of money, knock yourself out. But that's the whole point of the annuity is distribution of your wealth. It's not to build wealth. It's not to take risk. It's like, okay, like I spent the good part of my life building up $1 million or whatever it is. I just want to know that every single year I'm guaranteed to get a check, an amount of money, regardless of what's happening in the markets. That's where the annuities shine. And again, especially right now, like some of the payout factors are pretty high. I mean, the older the better. That's how it is with an annuity, because the insurance carrier, just to be blunt, I mean, they want you to die as soon as possible, because as soon as you die, the guarantee of them having to pay that money out is gone. And then on the life insurance side, like with the whole life insurance, for example, like we talked about, it's the opposite. They want you to live as long as possible because they want to wait as long as possible before they have to pay out the death benefit claim. So just kind of like a fun fact, I guess, something to see is like annuities, they want you to not live, they want you to die as soon as possible, just being blunt. And then life insurance, they want you to live as long as possible. But anyway, I'm going on a tangent, but point is, and I'm going to start to wrap it up here. You need to find vehicles to attach and enhance your financial portfolio when you go into retirement, to just allow you to live the retirement you want to live. And it can't just be based off of hypotheticals. Like, it can work out. Okay, and I'm not going to sit here and say that having all of your retirement, let's say we back up a step, let's say, you don't mind the volatility, you can ride the ups and downs, and that doesn't bother you at all. Like, that strategy can work, and I'm not knocking it, because there are some people where that does work for them. But if you're more on the conservative side and you don't like the fact that 2008 could happen in 2026 or whenever, maybe the end of 2025 as of recording this. If that thought bothers you, just know there's ways to eliminate that from you, from yourself. There's strategies you can implement to give you more peace of mind, to add in some more guarantees, and ultimately predictability and stability and certainty with your retirement.